Hello everyone, welcome to a short lesson video on International Accounting Standard 7, Investing Activities, Financing Activities, and a past paper question on cash flow statement for Cambridge A-Level Accounting. Before we proceed, please note that abbreviations are used in this presentation only due to space constraints. Abbreviations are strictly not allowed in the Cambridge exams. As per IAS 7, there are four parts in the cash flow statement format. The first part is that of operating activities, which are the main revenue generating activities of the business. These deal with the current assets, current liabilities, depreciation, and the interest and tax payment. The second part is the investing activities, which deals with the acquisition and disposal of non current assets and other investing activities. The third part is the financing activities, which deals with the issue of share capital, payments for the redemption of shares, changes in long term borrowings, that is, loans and debentures. The fourth and final part is the reconciliation of opening cash and cash equivalents with the closing cash and cash equivalents. The opening cash and cash equivalents figure will be derived from the opening statement of financial position, and the closing cash and cash equivalents figure we will get from the closing statement of financial position. We have already understood operating activities in a previous video. In this video, we will understand the remaining three parts of the cash flow statement format. Let us now look at the investing activities, that is the second section of the cash flow statement format. Under this category, the inflows would be the sale proceeds of non-current assets. Mind you, not the profit or loss, but the sale proceeds, that is the amount that you have sold the non-current assets for. The interest received by the company either on debentures of another company held by the company or on bank deposits that the company may have made. Also, dividends received by the company from any shares that the company might hold of another company. Outflows in this case would be purchase of non-current assets, that means the cost of any non-current assets that the company may purchase. Note that IAS 7 allows some flexibility in the treatment of interest received and dividends received. So these items may be shown as investing activities, or alternately, you could show them under the category of operating activities, that is the first section of the cash flow statement. Moving on to the next section of the cash flow statement format, the financing activities. The inflows under this category would include issue of share capital and raising or increasing loans. Please bear in mind that issue of share capital would mean the nominal capital amount plus any share premium that the company may have charged. The outflows in this case would be the repayment of share capital, the repayment of loans, and dividends paid. Again, IAS 7 allows some flexibility in the treatment of dividends paid. Dividends paid can be put under the heading financing activities, or it may be put under the heading operating activities, that is the first section of the cash flow statement. It is now time to combine all the sections of the cash flow statement and look at the cash flow statement in its entirety. Before you, there is a pro forma statement of cash flows. Let's go through it once. As usual, we will start our cash flow from operating activities with our profit from operations. To that, we will add the depreciation charge for the year. We will subtract any increase in our current assets. That is why you see that there is a bracket around this figure, because it is subtracted. We will add any decrease in our current assets. We will add any increase in our current liabilities. After we have totaled all these figures, we will get our cash from operations, that is 65,000 in this case. Then we will subtract any interest which is paid during the year. Please pay attention that this is the interest actually paid during the year. Again, we will subtract the tax actually paid during the year. These two are negative figures. and then we will arrive at the net cash from operating activities 52,000. Let us call this A. We move on to the second section of the cash flow statement, that is investing activities. So we have the purchase of non-current assets 20,000 negative figure. We have the sale proceeds of non-current assets 1,000. Interest received and dividends received 2,500. After we have totaled these figures, we will find that we get the net cash from investing activities. Let us label this figure B. We then move on to the next part of the cash flow statement, that is cash flow from financing activities. So we have the proceeds from issue of share capital. Please note that we are considering both nominal value and the share premium, that is $80,000. Repayment of long-term borrowings, it is an outflow and that is why it will be subtracted. Any dividends paid will also be subtracted, hence in brackets. After we have added these figures, we will arrive at the net cash flow from financing activities. Let us label this figure C. Now we have seen that there is a cash inflow of 52,000 from operating activities, a cash inflow of 16,500 from investing activities, and a cash flow of $46,000 from financing activities. We will add these three together, A plus B plus C, and that will give us our net increase or decrease in cash and cash equivalents during the year. So in this year, there has been a net increase in cash and cash equivalents of $81,500. To this, we will add the cash and cash equivalents at the beginning of the year. This figure we will find in the opening statement of financial position. So in this case, it is $10,000. So the year started with $10,000 in cash and cash equivalents. During the year, there was a net increase of 81,500 in cash and cash equivalents. And as a result of that, at the end of the year, we are left with cash and cash equivalents of 91,500. You may also cross-verify this figure of 91,500 with your closing SFP if it is given to you. Your closing SFP will have cash and cash equivalents at 91,500 and then you know that your answer is correct. Let us now solve a past paper question. This is May-June 2020, paper 3-1. So you are given the statements of financial position for W Limited, the opening statement of financial position and the closing statement of financial position. You have been given some additional information. Using this information and the statements of financial position, we have been asked to prepare a statement reconciling the profit from operations with the cash from operations, which basically means part 1 of cash flow statement. And in part B, you have been asked to prepare a statement of cash flows, but you have to start your answer with cash from operations from A. So let's jump right into it. As you know that we always start the cash flow statement with our profit from operations. In this case, profit from operations has already been given to us. It is $55,950. So let's write that down. Profit from operations is $55,950. Again, remember, no abbreviations in the Cambridge exams. At the beginning of the year, the value of the premises was $400,000, and at the end of the year, the value of the premises was only $380,000. That means that during the year, there was depreciation of $20,000 on your premises. Now, during the year, you have purchased machinery costing $28,000. But at the beginning of the year, the net book value of your machinery was $202,000. At the end of the year, the net book value of your machinery was $203,000. So, you started the year with $202,000 worth of machinery, You purchased during the year $28,000 of machinery and you ended the year with $203,000 worth of machinery. So what happens? Your depreciation is $27,000. So your depreciation on machinery is $27,000. So we add the depreciation on premises $400,000 minus $380,000, 20,000. Also, we add back the depreciation on machinery, which is 202,000 plus 28,000 minus 203,000, 27,000. Always write the working in brackets. Looking at motor vehicle now, a motor vehicle costing $65,000 with an accumulated depreciation of $26,000 was sold during the year for $32,500 and was replaced by a new motor vehicle at a cost of $74,000. Now, if you see in this question, we have not been provided the provision for accumulated depreciation, opening balance and closing balance. And that is why we will not be able to make a separate account for provision for depreciation. We will have to make it along with the asset account. So the motor vehicle account and the provision for depreciation account will be combined and we will have a motor vehicle account at net book value. So the motor vehicles given to you at the start of the year, the net book value is $118,000. At the end of the year, the net book value is $113,200. So now we'll prepare the motor vehicle account at net book value. Since it is an asset and assets have debit balance, balance brought down will be on the debit side, $118,000. And again, it is an asset, so balance carried down will be on the credit side. The balance carried down, closing balance was $113,000, $113,200. Then, during the year, they sold an asset, a motor vehicle. So, disposal. The cost of this motor vehicle was $65,000 and the accumulated depreciation of this motor vehicle was $26,000. Therefore, the net book value of the asset disposed was $39,000. Again, during the year, they have purchased an asset of $74,000. Now, we can balance this account. The total of the debit side is heavier, so we'll total this first. $192,000 on each side. And the balancing figure is 39,800. So what does this figure represent? It is the depreciation on the motor vehicle for the year. So depreciation of $39,800. So this depreciation on motor vehicle we will write here plus depreciation on motor vehicle and we will write working note 1. So the depreciation is 39,800. We also need to find out the profit or loss on disposal of motor vehicle. So let us prepare the disposal account. The motor vehicle disposed was of the net book value 39,000 and that net book value we will write here on the debit side. Motor vehicle $39,000. If you see, it has been transferred from the motor vehicle account to the disposal account, $39,000. This motor vehicle we sold for $32,500. Motor vehicle net book value $39,000 was sold only for $32,500. That means when we balance this account, 39,000, 39,000, and we get the balancing figure here, 6,500. What is this? The loss on disposal. This will be transferred to the income statement, and in the bracket, you will write loss on disposal. This loss on disposal is a non-cash expense, so it will be added back to the profit from operations. So loss on disposal, working note 2, 6,500. Let us now find out the increase or decrease in our current assets and current liabilities during this year. So inventory at the beginning of the year was 36,500. At the end of the year, it is 32,550. So there is a decrease in inventory of $3,950. Trade receivables at the beginning of the year was 46,200. At the end of the year, it is 49,300. So there is an increase in trade receivables of 3,100. There is an increase of $4,300 in the trade payables. We will now make a note of these changes in current assets and current liabilities. So we will write decrease in inventory, 36,500 minus 32,550, 3,950, it is a positive figure, minus increase in trade receivables, 49,300 minus 46,200. It's a minus figure, so we will write it in brackets, 3,100, plus increase in trade payables, 41,000 minus 36,700. That is 4,300. This will give us the cash from operations, which is 154,400. Now notice that we have not subtracted the interest and tax from the cash from operations. That is, we have not found out the net cash flow from operating activities. Why is that? Because part A of the question asks us to stop only at the cash from operations. So we will not subtract the interest and tax just yet. Let us now look at part B of this question. And it has asked us to prepare a statement of cash flows. And remember, it has asked us to start our answer with our answer from part A. We will now prepare the cash flow statement. As usual, we will begin with the operating activities. Cash from operations, because that is our starting point for this sum. We have found out the cash from operations in the previous part, 154,400. After cash from operations, we will deal with tax and interest. Tax payable at the beginning of the year was 12,600. The tax payable at the end of the year was 13,400. In addition to that, they have told us that during the year, the tax charged in the income statement amounted to 13,400. So this was our tax which was recorded as an expense during the year. So basically we note that tax that was payable at the beginning of the year, at the end of the year, and the tax expense for the year. But we don't know yet how much was the tax that we actually paid during the year. So let's find that out. So this is the provision for taxation account. We will start with the balance brought down. It is a liability for the business, therefore it will have a credit balance. Balance brought down was 12,600 at the beginning of the year. At the end of the year, your balance carried down was 13,400. During the year, taxation was charged as an expense to the income statement. So income statement must have been debited, and here we will say income statement on the credit side. 13,400 was the expense charged to the income statement. We will now balance this account, 26,000 on each side, and we have a balancing figure of 12,600 on the debit side. This is basically the tax that we have actually paid during the year, which is our actual cash outflow. From the cash from operations, we will now subtract the tax paid, which was working note 3, cash outflow, so subtracted 12,600. We know the interest that was payable at the beginning of the year, the interest that was payable at the end of the year, and we know how much interest was charged as an expense for the year in the income statement. What we don't know is the interest that we actually paid during the year, our actual cash outflow. So let's compute that. This is our interest payable account, pretty similar to our provision for taxation account. At the beginning of the year, the balance brought down is a liability, so on the credit side, and it is $2,500. At the end of the year, the balance carried down is given to us, it is $750. In the income statement, it would have been charged as an expense, so here it will be on the credit side. It is $8,250 of expense. So now we balance the account, 10,750. So you have a balancing figure of $10,000, and this is the actual interest paid, the actual cash outflow. So after this, now we will subtract the interest paid, which was working note 4, and it was $10,000. So now we can compute the net cash flow from operating activities. That is 131,800. After this, we go on to the second part, investing activities. So in investing activities, we have purchased machinery during the year worth $28,000. It is a cash outflow. We have purchased motor vehicle during the year. So that is $74,000 of cash outflow. We have sold motor vehicle during the year. So we will write the sale proceeds over here. That is, we sold the motor vehicle for $32,500. Now, when you add the three investing activities figures, you find that you get negative 69,500. Since this figure is negative, we will write net cash used in investing activities, not net cash from investing activities, but net cash used in investing activities. Next, we will deal with financing activities. At the beginning of the year, our share capital was $400,000. At the end of the year, the share capital is $440,000. So share capital has increased by $40,000. And similarly, share premium account, it has increased from $40,000 to $60,000. So there is an increase of $20,000 in share premium account. We will add these two figures up and write receipts from issue of share capital. So receipts from issue of share capital is a cash inflow, and the amount is 40,000 plus 20,000, that is 60,000. Now there is a change in retained earnings too, but that does not affect the cash flow, and that is why we will not take that into consideration. The same logic also applies to revaluation reserve. We will now look at the bank loan. We started the year with a bank loan of $100,000 and ended the year with a bank loan of $30,000. That means we have paid back $70,000 of our bank loan. So that is repayment of loan, $70,000. I have run out of space in this slide, so I will continue in the next. The next thing that we will look at is the interim dividend. The nominal value for each share is $1. That means we had 400,000 shares at the beginning of the year and 440,000 shares at the end of the year. He says that interim dividend of $0.11 per share was paid in August 2019 before 40,000 additional ordinary shares were issued. That means interim dividend was paid on these 400,000 shares, and the interim dividend rate is 0.11 per share. So that means we have paid interim dividend of $44,000. So dividends paid $44,000 of outflow. So the net cash used in financing activities is $54,000. We will now add the net cash from operating activities, the net cash used in investing activities, and the net cash used in financing activities. This will give us the net increase or decrease in cash flow during the year. In this case, it is a net increase in cash and cash equivalents of $8,300. To this, we will add the cash and cash equivalents at the start of the year. I have taken this figure from the opening statement of financial position. It is $8,100. You started the year with this much cash. During the year, the company saw this much cash come into the business. So at the end of the year, you are left with $16,400 of cash and cash equivalents. If you want to verify your answer, you can check the cash at bank in the closing statement of financial position, and it will be the same as your cash and cash equivalents at the end of the year that you found out in the cash flow statement. So that was IAS 7, Investing and Financing Activities. We will cover a sum of a different nature in the next video.